The market is still in pretty rough shape. You see here, looking at the S&P, we hit new lows recently, and even though we're bouncing, the chaos is not over. Just to review, we're looking for two things to know that this market has bottomed out. The first thing that you need to see is capitulation. And that just means total despair, with everyone selling and sentiment hitting extreme bearish levels. Because what that means is that everyone has pretty much pulled their money out of the market and there's not much selling left to be done. So at that point, what can you do other than buy, right? The money has to come back in at some point. And the next thing that we want to see after that happens is a strong breadth thrust in the market. And a breadth thrust is a high volume day where most of the market, like all of the individual stocks, move together higher. You don't want to see just a few stocks going up on a green day because that means that the internals of the market are weak. You want to see all the stocks moving together. That's the strongest type of market that you could have. And a few of those breadth thrusts in a row will tell us when the market has bottomed out. That has not happened yet. And I'll have a full review for you on Tuesday like normal. But what we know is that if we don't see those two things, we're going to continue in this sideways volatile market. Oh, and sorry, one more thing we want to see is rates. We want them to stop rising so fast. And just based off looking at the chart right here, they might have slowed down a little. But again, we'll have a more full review on Tuesday. But assuming we continue in this sideways to downward volatile regime, which is, as we said, one of the most difficult to trade. And why is that? That's because if you have stops, they get run. So because the market's going like this, individual stocks are going like this too. So oftentimes they'll hit your stop and then run back up. And then of course they'll come down again, but you feel like crap the whole way because it's like, oh, I just got knocked out for no reason. So they frustrate people on the upside too because you try to go long and again, it just turns around. It hits a certain point, plummets. And it frustrates the people on the long side too because again, you try to go long and what happens? It turns around and it plummets. So very difficult market to trade. And this is the type of market that we're in. So even so, our team at Macro Ops, we're looking at strategic stocks that we want to buy and we're even investing in them right now. So some of the questions we've been getting lately is how does that work? Because we know you don't want to trade against the trend, right? You don't want to be buying stocks when the entire market is falling because that lowers your chances of any success. Because we know that 50% of a stock's move comes from the general market, 30% from the sector it's in, and then 20% from that individual stock. Meaning, yeah, you don't want to buy in a downtrend. But even so, you see us buying in the Macro Ops portfolio. So what's going on? So the question is, how do you balance not buying in a downtrend and not buying when the individual stock is falling with the idea of getting a good value? So you want a good value, but you also don't want to be catching a falling knife, right? So how do you do that? That's what we're going to talk about. And unfortunately, it's not a black and white answer because there's many different ways to trade the market and everyone does it differently. And not only do people do it differently, but they're super successful doing what seem like opposite things. So let's go over a few ways you can approach this in a market like the one we're facing. Now, the first most important thing, as always, is develop a system and stick to it. So whichever route you choose, however you want to invest in the stock market, have a set of rules and keep following them. Because no matter how different all these processes are, depending on what type of investor you are, if you don't follow your own rules, you're going to screw up. You're going to lose money. And what is the number one rule in markets in general? It's never lose money. Okay, so one way to invest is to be like Buffett, like a value investor. So these guys are really good analysts. They're able to read a 10K and know exactly what's going on in a business. And the way it works is that obviously they assign a value to a stock, and if the stock is trading below that value, a price lower where they think it should be, they buy that stock with the idea that it'll go back to that fair value price and they'll make money. Now in this market, like we've talked about in previous videos, there are a lot of stocks on sale right now. Good stocks. Now, a lot of sectors are down 90%, but within those sectors, there are certain stocks that are true gems. And they shouldn't be down that much. They're like the baby being thrown out with the bathwater. So those are the stocks that we're looking for, and value guys will be looking for them as well. But here's the problem with being just a pure value guy. Once you buy that stock, you have to sit through all the volatility that's going to happen. So right now, you buy one of those gem stocks, right? That's really great. So say, for example, right now, you buy one of those stocks that you think is a gem. It's way undervalued. Well, if we're still in this sideways to lower market, then what's going to happen? You're going to lose a bunch of money. And here's the thing, if you're a value investor, what happens when a stock price goes down? You're like, oh, it's an even better value. That's the theory anyway. So some of them buy even more. But again, actually doing this is very difficult because some of these stocks that are great that I've been tracking, right, down 90% already, they're dropping 15% in a day still. So if you're a value investor and you've done your analysis, you're like, no way, this shouldn't be worth this little. You're still getting hit with those 15% in a day drops. How's that going to feel? Are you actually going to be able to sit through it? Most people, no. No. So you end up puking out at the lows and your whole strategy is screwed. That set of rules that you had, very difficult to follow. You don't follow, you break it, you lose. So that's another important thing when you're setting up a system, make sure it matches your personality, because otherwise you're not going to be able to follow your own rules unless it's a perfect match. So that's very important. Now there's another problem with this strategy too, with being the Buffett style value investor. And that problem is that you only have a few chances at bat, because if you're a value investor, you're putting a lot of money into a few positions. And those positions only come once in a while. And once you're in them, it takes a long time for them to reach fair value again. So basically your feedback loop is a very long one. So think about being a day trader. You're taking all these little trades and you know within the day whether they're successful or not, whether you're making a profit or not. But if you're a long-term value investor, you might have to wait years to see if your thesis plays out. And again, how many people have the patience for that? Not many. And the other problem is that if you're waiting years to see if something works, you don't actually know if your strategy works or not. So imagine you decide you're a value investor, you buy 5 different stocks today, you use up all your capital. But you have a 3-year time frame. Well, at the end of the 3 years, when all your stocks are still down, you're like, oh, wait, am I not a good value investor? And then you just lost 3 years. And that's an example of an amateur value investor, but this happens to professionals as well. If you just look a year ago, there is value fund managers who were being praised like as geniuses. They're like, wow, your 5-year track record is amazing. And they were raising so much money. But then in the last 6 months, a lot of them have closed down after losing all the gains that they made over those last 5 years. So there you see another problem. The strategy that they were using worked really well in one cycle, and then as soon as the market changed, they got blown out. So again, very difficult to see when your cycle is so long. And the thing is, if you want to be a good value investor, you got to be able to survive cycle after cycle, and most don't. Which is why I always talk about in the hedge fund game, it pays these guys to do something really big within a 5-year period, right? Really go balls to the wall, get the biggest returns you can, and raise the most amount of money you can within that time frame. And a lot of these guys might not even care that their strategy won't work in the next cycle, because if they raise all that money and they charge their fees, they're going to become rich. I always say this is the Cathie Woods example. Now, I don't disagree with Cathie Woods and her optimism about certain stocks in the future. I agree with it. But at the same time, how do you manage that? Like ARK is down how much now? Yeah, they're down over 70% right now. Because these same stocks that might be a good idea, I think most of them will fail, but some of them might be great in 5-10 years, they're down a lot right now. So where is the trade management? It gets confusing. But for Cathie, it didn't matter as much because she was so hyped up during the period while it was working, and she raised so much money that she's set for life now. She's set for multiple lifetimes, actually. So it's a different type of game that hedge fund managers play. But for you and me, we don't have that option, right? To just blow out and then start a new fund. Bill Ackman, that's another example. He does the same thing. He has blown up many funds and he's come back again and again. But again, we don't have that option. We got to have a good system that we could stick to with solid risk control so that we could survive cycle after cycle. So again, the most important part in picking that system is knowing yourself, because you need to pick a system that matches with you. So in the case of Alex, who's our lead researcher at Macro Ops, he's not a Buffett style guy. His strength is understanding sentiment, which is why we do so much sentiment analysis in these videos. He's able to understand when markets hit extreme points. So in the beginning of this video, we were talking about what we need to see to have this market hit a bottom. He's really good at that. So he can see extreme bullishness and he can see extreme bearishness. And he's able to jump in and play the other side of that. That's his strength, that's his strategy, and you can see it's not very similar to like a Buffett value. But his ability to analyze extremes also comes in handy with stocks. Because when a stock is down 90%, but he knows it's an obvious story with good value, he's able to start playing it because he sees it hitting the extreme. So okay, if you have a stock, right, that's down a lot, but you know the market hasn't bottomed out yet, how do you start playing around with it? Well, what we like to do in the Macro Ops portfolio is start with small positions. So it's like testing the waters. You don't want to put in your full position in right away. You want to do it in chunks. For example, one stock we're looking at, we want to build a big position in. We think this thing is going to be $1 trillion company, but the market is still falling and this particular stock is still falling. So a few weeks ago, maybe about a month ago, we put in a tiny little starter position. And guess what? The stock fell more, but that was okay because we had such a small position. And when we have a small position like that, when the market moves against us, we're not getting hurt. Because again, what's the #1 rule above all else in the market? It's risk management, not losing money. And this methodology methodology that I'm telling you about right now, this is a form of risk management. So Alex has that feeling, and according to his rules, this stock is reaching an extreme, but he also understands that he could be wrong. Maybe this stock can fall another 50%, who knows? That's why he puts in that small position to test it. Now, just a few days ago, which is a month after we put our first position on, we added a little bit more. This latest add has been working a little better. But again, even if it didn't work and the market moved against us, we still wouldn't be hurt that bad. So the benefit of this is that we're getting this stock at a good value because it's dropping, right? We're getting it at the cheapest prices possible. But we're also guarding ourselves from the fact that, hey, the market hasn't bottomed out yet. So there's a good probability that it could drop lower. But by having that small position, we are going to be protected. So we're kind of hedging both ways. We believe, okay, this stock is in an extreme and it should go up from here. But we also know that, hey, we could be very wrong and the market can keep dropping. So we're playing both sides a little bit, and that's what you got to do, because you can never be fully confident in the market. You never know what's going to happen. That's why risk control is always the #1 thing to focus on, because it's the only thing that you can trust. You can trust that you're going to be wrong a lot, and you can trust that the market is going to try and take your money. So naturally, risk management should be your main priority. So that's the method that Alex chooses to be able to buy this stock at a great value while still protecting himself and the portfolio. Now, if we take a look at how I would do this, playing this same stock, I wouldn't be trying to buy it here at all, because that type of strategy doesn't fit my personality. I'm not perfect at being able to tell when there's extremes in the market. That's Alex's thing. Me, I'm more of a systematic momentum guy, and you know that if you use the all-stars. So in this example, right, of this amazing trillion-dollar company, well, if I'm seeing it, say, drop 15% in a day, I don't really want to touch it right now. What I want to wait for is a long-term base to form, and I want to see a breakout. Then I'll start looking at this stock. And that's kind of momentum, how it works, right? And a lot of times with momentum, what happens is that you miss the first part of the move. A lot of people look at that and they're like, oh man, you already missed a 50% up move. Like, that sucks. Like, why would you even do this strategy? But there's this idea that I got from another market wizard. I think it is PTJ. So he said that he never tries to catch the first third of the move or the last third of the move. He just tries to go for that middle. Because say if this company is a $1 trillion company and it's going to be incredible, it's going to have a long, long run with its stock price. So I'm not trying to catch it at the beginning or the end, which are the two toughest parts. Because at the beginning, you have this problem where it keeps dropping, right? Where you're trying to get it at the best value. You don't know when it's actually going to start going up. And at the end is when it starts topping and you don't know if it's going to keep going higher or turn around and plummet. So that middle part is that sweet spot for momentum. And that's what I go for. Again, don't care about the first or the last third. And that methodology fits my risk management rules. And it really reduces my downside because by the time I'm getting into a stock, it's been running pretty well. And with that strategy, when we use momentum, the truth is that we don't really need to know what the stock even is. We don't need to worry about fundamentals, which is why I like it, because you could be even more systematic. It becomes math. We do a regression analysis and we blend time frames between 30, 60, and 90 days to see how a stock is moving. And if it's moving right and it fits our conditions, we're going to buy in. And if you know our strategy with the all-stars, you know that's the TSI rating. That takes all those factors and tells us how a stock is moving. So I like it when you could boil it down to that quantitative number. And for me, what I believe in markets is that if the price is moving in a certain way and it's trending in a certain way, then clearly something right is happening with the fundamentals. Or maybe the fundamentals are trash, but it doesn't matter because everyone thinks the fundamentals are great. Because what are markets made up of, right? We got technicals, fundamentals, and sentiment. And they all influence each other and they all affect each other. So I believe, like PTJ, that price is king. So I'm going to follow price. And I also believe that everything in the market is distilled down into that simple price measurement, which is why I can just use that and be good and successful. But again, that works for me. That does not work for Alex. He does not like doing it like that. It doesn't work for a Buffett style guy. So again, different ways to do it, but you just got to pick one. And the most important thing in all those strategies is the risk management. Because as we know, in case you forgot, markets are dangerous. And we've all been reminded of that for the last few months. This whole year, really, it's been brutal. Now, the stock that we've been talking about in this video, we actually covered in depth in a previous video, which I'm going to link to right here. I didn't go too much into detail about which stock it was in this video because I wanted to make sure that you get the full picture. So you could really see why it's a $1 trillion company and why we're so interested. So you could really see why it's a future $1 trillion company and why we're so interested in it. And you'll see why it should be on your watch list. So click this video right here and we'll explain it all. I'll see you there.